we are really, really excited to welcome to the stage your special crypto tax panel. So we're going to start off with Simon Akozu, who's partner at MinterEllison. Rupert Carlyon, who is the founder of Kōura Wealth. James Cochrane, partner at Neave. And last but not least, Tim Doyle, Director of Doyle Accountants.
Kind of thinking, what would you like to hear from me as a tax lawyer in the New Zealand market? Maybe I'll start with kind of my crypto tax journey. So prior to meeting Jeremy Muir, who some of you will know, in 2018, I didn't actually pay much attention to crypto tax, but when I joined my current firm, I was forced to because of all the work he's doing in that space. And my impression of the market at that time and the tax settings was very much kind of in keeping with the fast and loose. You know, it was the Wild West. We did not have answers to basic questions. So if you asked me in 2018, does GST apply to the sale of Bitcoin? I could not, as a tax lawyer, write an opinion saying that it does not. And that only became possible in 2022. So it was very much a Wild West. There were all sorts of analogies that people were trying to draw to other areas of tax. And so we had digital gold as being really the key kind of analogy that was being drawn between gold and Bitcoin and how Bitcoin should be taxed, because that was a predominant kind of cryptocurrency that was focused on tax at the time. We had all kinds of interesting discussions, including with IRD, on whether it was possible to be a hobby investor. And I think some of my first clients were people that had mined Bitcoin on gaming computers while they were studying computer science at university, and having some really interesting discussions with IRD about to what extent did their activities constitute a business. I think it's fair to say things have kind of moved on from that. So it's less wild, it's less fast and loose. And some of the grey areas that used to trouble us and meant that if you wanted a legal opinion, you weren't getting one, those grey areas have started to be resolved over time. And I think the 2022 tax changes for those that keep score in the tax world were big, because they clarified some basics like GST not applying when you sell Bitcoin. So anything kind of defined as a fungible token, not subject to GST. But then there were obviously still some problems at that time, because 2022, NFT boom, all kinds of crazy stuff happening, people wanting to launch all kinds of ventures. And obviously the implication of IRD's changes in 2022 was that NFTs were certainly subject to GST, subject to zero rating, depending on who your ultimate purchaser is. Since that time, I think things like staking and DeFi, I've spoken at conferences with people in the crowd, I said super in there before about things like that. We're still engaging with IRD on that. Probably the key takeaway is that there's kind of no one size fits all. So if you're trying to analogize to rulings on kind of Ethereum staking or something like that, it's not always going to work. So I still think while we've solved some of the big picture problems, there's still further uncertainty in how our tax law applies to things like DeFi and staking. So if you're doing it, be aware that IRD is currently thinking about it. And I think hopefully we're going to get some more clarity on that in the near future. But it is something that I think it remains to be seen whether we're going to get kind of the answer that you guys want. And I'm suspecting that's towards the low tax end of the spectrum in terms of answers. I would also kind of make the comment that there's increasing regulation, not just in terms of how you calculate and pay tax, but in terms of the frameworks that are being implemented for collection of information from on-ramps and off-ramps around the trades that you might do. So you will have heard about FATCA and CRS, and you might have heard about IRD's requests to exchanges for information about transactions. 1 April 2026 next year, we're getting the OECD's crypto asset reporting framework that IRD is an enthusiastic early adopter of. And I think that's kind of part and parcel of kind of the maturity of the market, and the fact that we are moving towards more mainstream and more regulation probably in this space. And it's really kind of interesting to kind of talk to the panel here around the growth of things like PI funds that might invest in offshore ETFs, for example, as a way to kind of bring the product to market in kind of a more user-friendly manner. You're not self-custodying, get the nice kind of PI wrapper and those types of things. So I think it's overall like a really positive kind of message. We are seeing taxpayers get into trouble with IRD on some technical points. So ideally that's not you, but if you do have issues, I would say that IRD is still in the mode of trying to work towards sensible answers with taxpayers. So that's my experience. So I think, it's a maturing market. I think we've got more answers than we had, but there's still some answers left outstanding. One of the things that I think you should probably be focusing on if you do have questions about your own crypto asset reporting is whether or not you should be looking at making voluntary disclosure, for example, because it tends to be the case that if you go to IRD admitting a problem, they are much nicer to you than if you have concealed that problem and had waited for them to come knocking. So probably based on my experiences in the space, and I won't pretend to have represented everyone, I certainly haven't, and there'll be others with more experience in this room on this. But the general kind of vibe is if you're going to let it simmer, that's probably the type of approach that will get you in more trouble over time because of the way that penalties and interest can rapidly accrue. So I would say if you do have questions, fair enough, it's complicated, especially around staking and DeFi. If you do ultimately find you have a problem, I guess a voluntary disclosure is kind of a common route towards kind of resolving that. But that would be kind of my key takeaway. Don't maybe let it kind of simmer. I know kind of if it's hard, the temptation is to say, well, maybe I won't look at it because I don't know the answer. But in my experience, that doesn't tend to work out well in the end. And with reporting frameworks, collecting more information, I don't know how long you'll be able to kind of fly under the radar. I think we've moved from the Wild West towards more regulation. That's kind of where I see it going. So probably not the answer that you necessarily want to hear in terms of where tax is going on this front, but I think we are moving more into kind of the regulation and enforcement. So it's possible that, depending on what you're doing, you might need to kind of talk to one of the panelists about how you might resolve that. If you think back to the very first kind of analogies around how crypto should be taxed, and if you think of it as digital gold, ID's perspective on things like Bitcoin is that, well, it's kind of like gold. You don't really, or gold bullion, you don't really invest in it other than to make a gain on disposal. And so under our intention-based tax texts, the presumption for many types of cryptocurrencies, I won't say NFTs because they have different purposes for listing them, but many types of cryptocurrencies is you've bought them for sale, and therefore if you do sell them for a gain, you've ought to be taxed on that. And we don't have kind of a capital gains tax rate discount in New Zealand. It's just taxed as ordinary income. So if you're on, I don't know, let's just pick an example, a 33% tax rate, and you've kind of bought and sold Bitcoin and made a $10 gain, on the face of it, you're looking at the $3.30 worth of tax, if I've got my maths right. So the maths is not complicated on a single transaction basis. It does get harder. If you're one of those people that are doing thousands of trades, I would recommend the man sitting next to me, Tim Doyle, because we've talked about more kind of creative ways to solve those problems. Because with fungible, how do you kind of apply a cost base? How do you even calculate your gain when you sell? So I think in an isolated kind of situation, it's kind of easy to talk about what your tax is. But if you're one of these people that have thousands of transactions, someone like Tim or one of the software products in the market might be the way to go. NFTs, completely different ballpark. I think it is more, that is a space where it's easier to argue that you haven't bought for disposal. Perhaps you bought a collectible because you simply like it. We're talking about bought a club or punks. Maybe you've invested not for sale, but because you like it in the same way that you might buy art because you like it. So the capital account argument is more open on that front, subject to what you do in practice. If you have big trades and a regular frequency, that might still kind of fall over. Probably a fishhook in NFTs is not excluded from GST. So we have this basic distinction between fungible and non-fungible. If you're selling NFTs, be wary of GST treatment. Although if you're selling on a global exchange, perhaps the presumption is that New Zealand is a fraction of the overall market for NFTs is so small. Perhaps it might be reasonable to take the view that it's an exported sale, it's zero rated rather than standard rated for GST. Beyond that, I think staking and DeFi, that no doubt others will touch on, more complicated than that. It's really a question of whether or not the arrangement that you've entered into when you've locked up your crypto, is that a disposal for tax or not? Because the general trigger point for taxation is when you no longer have the crypto because you've either sold it for fiat or you've swapped it for something else. When you've staked something, do you still have control over that crypto or not? Have you retained key? It's all going to be very nuanced based on your specific arrangements, but there is a possibility that taxable on disposal. And then when the rewards come in, ID's general view is that some sort of services income. It's kind of similar for, like, I don't know if anyone's mined Bitcoin. It's probably a bit more old school. It's probably quite intense computers to do that now, but the analogy there is you're taxable when you receive your mining reward, essentially as remuneration for services. And there's a similar argument in a staking context as well. But that would be kind of my overview. If it's a cryptocurrency, a more traditional cryptocurrency, probably presumption is that you bought for speculative gain and therefore taxable. That won't always be the case. If it's an NFT, it has more arguments that it's on capital account. Staking and DeFi, complicated, increasing regulation coming. So you might want to have a look at kind of compliance if you haven't focused on today.
So I'd like to direct the next question to you. Could you introduce yourself and also tell us a little bit about how can we report crypto transactions?
So my name's Doyle. I'm the director of Doyle Accountants, and I guess what we do is prepare cryptocurrency financial statements and tax returns for our clients. So we take all of your trading records, all of your activity records, how you bought crypto, follow it through every single activity through what's your closing stock at the end of the year or how much cash is in your bank account, reconcile all of that, and then you declare that with the IRD, and then give you sort of tax advice on how much tax you have to pay, when it's due, does corp tax pay, what bill, etc. So we do that. We've done it since 2017. That's when I first got in crypto, and I think as Simon summarised quite nicely, the landscape has definitely changed, as well as some guidelines from the IRD, I guess the things that we're doing now which are different. As far as reporting your actual crypto to the IRD, believe it or not, IRD get a single figure that goes into your tax return. So for the majority of people who buy cryptocurrency as a speculative investment, who's not in business, they're going to get a single figure, and that could be a profit, hopefully, or perhaps if you're less fortunate, a loss. And that cryptocurrency income gets combined with your other income sources, salary, self-employed, interest, dividends, etc. It gets returned to the IRD. So although IRD get the single figure, they don't know how it's been calculated. They don't know how much crypto you actually hold. They don't know the tokens that you've got. They don't know the trading records that you have. However, that doesn't mean that it's not important, because in New Zealand, the onus is on the taxpayer, all of us, to show our evidence and proof of how we've calculated that figure should it ever be questioned. So as part of what we do is we tell that journey of how you've transitioned through the phase to calculate that profit. And this is no different from other businesses. So there's kind of leading into that second question, there's no kind of specific crypto tax legislation. There are a couple of key points. So as Simon mentioned, there's the GST exemption for crypto that came out. There's also some specific legislation about exempt financial arrangements, in particular criteria that apply to those. And you can get into the weeds around some of this legislation, but the reality is that for probably most people in the room, there's going to be two key parts that apply to them. If you're in business, you're in a business of trading cryptocurrency, which is no different from being in the business of running a bookstore, or you've bought cryptocurrency as a speculative investment. Yep. So when you look at those parts of the Income Tax Act, there's nothing specific that applies to cryptocurrency. There are some other guidelines from the IRD, for example, around if you're paid in crypto and whether PAYE or FBT applies to that. And before Christmas last year, there was also some guidelines that came out. Might have actually been an issues paper around how crypto applies for temporary foreign tax residents. So new migrants coming to New Zealand, they actually get a 4-year tax exemption on foreign source income. So there's a few sort of nuances on them, but again, that's probably not going to apply to the majority of us who gets doing. So yeah, that's a bit of an overview on all these couple of issues. Yeah.
Awesome, thanks, James. I'd like to ask you a little bit about your extensive blockchain Web3 background. And also, I think Simon, touched on NFTs, but I think it'd be very interesting also to kind of know about the taxable events that NFTs trigger and potentially if you can get into airdrops as well.
I'm a specialist in financial services, and I got interested in crypto because of insolvencies, the called crypto insolvencies. I managed to orange pill myself and fall down that rabbit hole and identify that I may have some undiagnosed OCD when it comes to this topic. But, that led to me becoming deeply interested in it. I actually wrote some articles on tax very early on for me and my jig, just to understand for me where, for example, if you're acquiring BTC and transferring it to Polkadot and then going, I'm quite interested in chain link only. Do I have a taxable event, from something like that? I'm flattered to be invited to this panel because I do not profess to be a tax expert. I am a litigator, but my Web3, portfolio involves both front-end advisory work, so we do work for a whole range of different clients on, for example, financial markets, advice, asset structuring, and my colleagues may need help with that. And I also deal with, being a litigator, I deal with the contentious side. So, for example, we might exploit a client who's facing action by one of the regulators or is wanting to argue a point. And so I'm also part of the Blockchain NZ Council. There's a couple of the other gang here amongst the crowd. And so I'm here in that capacity. That's a little bit about me. But in terms of NFTs, I thought I'd talk about a bit of a war story, because these two are the experts, and I'm not going to muck around. If we have a client who has a serious tax issue, then often we will recommend that they seek tax advice from another party, accounting advice, financial advice. So I'm not giving any of that here, big disclaimer.
I think that applies to what Simon said.
Yeah, so, but we have given advice to some clients, for example, in the gaming sector, parties have established NFT projects, that sort of thing. And I remember one of my early instructions was around whether a client had a potential tax liability in respect of NFT project they were interested in. It's called CyberCongs. It's an ETH NFT project. And I recall trying to explain to the tax consultant of the firm at the time what was going on with what they were doing with these NFTs. And they had been acquiring the Kongs, they were staking them in order to earn banana tokens. And then from the banana tokens, if they held the banana tokens and were staking them long enough, they'd receive airdrops of baby Kongs. And so trying to work out, I think my colleague was a 55-year-old gentleman, had no idea what we were talking about. And I think it is, picking up on what Simon had said, the market has evolved massively. There's a lot more guidance than we had at the time, 2020, when I was started really providing advice on this topic as a specialist. And, that particular, scenario of the Kongs gives rise to a number of different considerations. This was something this person was not doing as a full-time job. They were doing it, in the evenings, maybe on the lunch break or something like that. Just, I remember, that period of time, NFTs were just going completely wild. I think Bored Apes were 150 43 ETH or something like that, for, some of the top ranking ones. So it was just that it wasn't a scenario where this person was actively setting out to do it as a business, but because of the way that our tax system works, there was potential for what they were doing to be considered as a profit-making scheme and viewed that the baby Kongs, which were airdropped, which they had, there was a argument that yes, okay, these could be what's called a capital asset, so the gain on the value of the baby Kongs shouldn't be taxed. There was an argument about that, but equally, if they were viewed as part of the tax profit-making scheme, they could be seen as income, particularly if they were sold. So I guess looking at particular tax events, what a lot of particularly newbies don't appreciate is if you are transferring from BTC or ETH or even USDC or whatever into an NFT, you're going to have a disposal at that point, taxable event. And so you could have a tax liability in respect of any gain, possibly a loss, on the value of the original token. And then there are questions around I guess in this case, the cyber Kongs, why were they acquiring them? And this comes back to sort of the basic test, which is what they call the dominant purpose test around the acquisition. So you're looking at a taxable event when they are sold as being the point in time when the IRD is considering the issue, but the relevant consideration for the person who's acquiring the asset and whether or not it's likely to give rise to an income tax issue in terms of a gain on the capital value of the asset is actually determined by what they intended at the time that they purchased the asset. So what was the client doing when they intended to purchase the Kongs? Were they buying them as a hobby? Were they buying them as part of almost like a business? If they were, sorry, I'm rambling on here, but the long story short, we thought there was a good argument that any gain in the Kongs themselves might not carry a tax liability for income tax, but likely the banana tokens, which were the staking rewards, they were likely to be, yes, what you call the fruit of the tree, Kongs being the tree, the banana tokens being the fruit, so they were taxable as income. But I guess my point here is that this could be super complex, super challenging if you're doing this on sort of large scale, and it's very easy to get carried away one afternoon, buying cows and various other types of animals and trading them back and forth. And that's why we have things like software that can assist people like Tim to help you avoid a liability. And I guess as a litigator, it can get really, really expensive if you are involved in any sort of court litigation. When you're dealing with a regulator, they are well resourced because it's your money that they're using to try and recover the tax or prosecute a breach of the Financial Markets Conduct Act. So it pays to get good advice early on. Don't end up with someone like me in court having to have a big argument, because that can get really expensive.
Awesome, thank you, Dave. Fun fact, my last name is actually Kong, so I'm absolutely going to start calling my children baby Kongs and the fruit of my tree. That is what I just
I noticed, I just did a search for Kongs today. I think you can pick up a baby Kong for 0.3 ETH.
What about in banana coins?
Yeah.
I need to start investing in them. last but not least, I was just wondering if you could tell us a little bit about yourself, and also if you could elaborate on kind of like the different ways that you can be exposed to crypto and the tax implication of that, because it's not just directly, there's many different ways to be exposed, and with you and what you do, I think you could be the best place to answer that.
Thank you. Not sure I'm the best place. You can get it. These three are going to be far better than me answering any tax questions. I'm Rupert, Carlyon, MD of a company called Kōura. We're a KiwiSaver scheme, but we're the first people, the only people that launched a Bitcoin KiwiSaver scheme. We took the view that KiwiSaver is your money. You need to have the options and the choices to do what you want, and that's why we've given people the opportunity to invest part of their KiwiSaver in Bitcoin. I guess why that's relevant to this conversation, because I'm not a tax expert. We went through this journey when we launched this fund 3 years ago, because fundamentally there are lots of different ways in which we, as an institutional investor, can buy Bitcoin, and we needed to do it in a way which was the most tax efficient for our investors, because fundamentally a big part of being a successful investor is all about minimising your expenses, of which tax will be the biggest one that you're going to incur on the way through. When we started on this journey, the first two things we looked at were, do we go and invest directly in Bitcoin? And actually, Ben Rose, who's standing over there, he kind of spent a long time talking about should we use the Binance custody platform to buy it directly. Or at the time, this was before the US ETFs, could we go and buy an ETFs in Canada, actually, to go and do it? And it was kind of a really interesting conversation for us, because we were sitting there going, as we believe in kind of, why should we go buy another fund? Why should we do all of this? We kind of liked the idea about owning directly. We thought it was a good story for our underlying investors as well, until we learned about the tax. And fundamentally, that's kind of, we took the view that, absolutely insane to own Bitcoin directly. For the very simple reason that you've heard a lot more about how Bitcoin, you are taxed on the capital gain or capital loss. All crypto assets will be taxed on capital gain or capital loss. The beauty about investing through a fund, or particularly one of the ETFs that's now available, is that you will be taxed under the foreign investment fund rules, which are then taxed under the FTR. And tax guys love the acronyms. But effectively what that means is you will pay the lower of the capital gain or loss, or a maximum gain of 5% on that asset. So what that means is we have a year like we just had, where crypto's gone up, or the price of Bitcoin's gone up 50% in the last 12 months. You're going to pay tax on a maximum of 5% of that. That's a lot better by doing it in that structure than if you hold it direct liens. On the flip side, if we're about to head into the bear market, depending on what happens tomorrow morning, and things go really, really negative, then if over the next 12 months we take a 50% loss on our Bitcoin, you're actually going to take the credit of that the whole way through. So actually, if you're in the top tax bracket, you're going to get a 39% rebate on that on the way through. So it's kind of, you monetize the losses and you keep the gains. Very, very rare that you're going to come up with a structure like this. And that's why for Bitcoin, it's actually, all crypto assets, unfortunately, at this stage, the opening kind of ETFs you can buy at Bitcoin and Ethereum. There's another couple in Canada, which are quite interesting as well. But that, for a highly volatile asset, I personally think it creates quite an interesting opportunity to trade those gains and losses, and you can actually make a bit of money out of that tax there as well. So that was the first leap that we went through, right? And actually, for us, unfortunately, it makes no sense to hold it directly. I have to say, it makes no sense to me. Probably doesn't make that much sense to other people either. The other point is that then we went, then you can go, the next layer is then go put it into a Pi wrapper or your KiwiSaver. So the Pi regime is the tax regime here in New Zealand, portfolio investment entity, which is effectively the investor fund. But that's effectively how investment funds are taxed here in New Zealand. And one of the beauties about the Pi regime is every member of the Pi fund, or every unit holder, of that fund is effectively taxed on their own individual basis. And the big difference here and why it's advantageous to people is that it does two things. The top tax rate under the PI regime is 28% versus 39%. So if you're paying 28%, you end up paying 28% of 5% versus 39% of 5%. So that's already a gain. The other reason why for a lot of people under the PI regime, it's a much simpler answer is because what we will do, what your fund manager will do, is they just deal with all of the tax. Everything happens in the background on the way through. And it's just dealt with on a yearly basis. So for example, 31 March on Monday, today, we're paying on our Bitcoin fund a whole lot of tax on behalf of our members. It's just easy, it's dealt with, and it's done. And so that's kind of where our journey's gone through of going, it's actually under a PI fund structure of which your Kiwi, that is what your KiwiSaver is. It's a very easy, low admin way to do it. So I just thought it's important to kind of think about, so I think there's a lot of how you pay your tax and making sure you pay your tax. The one thing, I've spoken to a few of the exchanges, don't think you're going to get away with not paying your tax because IRD is seeking all of that data. And so it's going to be very, very hard to hide. But the way to avoid kind of getting yourself in trouble is do the work up front. Figure out what your objectives are, why you want to hold that crypto, what you're trying to do with it, and then have a good look and go, what is the best structure for you and how you can get that exposure as well, because that's going to be the way to minimize the tax. Yeah.
Cool, thanks, Drew. That's super, super interesting. Our legal counsel, Elton, is going to kill me for not have done this earlier in the piece, but I do need to limit that nothing discussed here should be taken as like individual tax advice. And if you want individual tax advice, you should seek a professional tax service. I see him shaking his head at me. So disclaimer, I did say that.
I took one of them.
Yeah, so okay.
Does it make a difference if you got tax professionals giving you advice?
I think we've said it's largely taxable, so I'm comfortable with it.